All right. Good morning, everyone. My name is Tashana Johnson. I use she, her pronouns, and I'm a program manager for the Whole You, which is your well-being and engagement team. We're here today with Jeff Wood as well as Valerie Mitchell from HomeStreet Bank Affinity program. We'll be learning about understanding credit and what that means, what impacts it, and maybe some strategies around navigating it. A reminder that we are recording today's session and it will be shared out later on this month after it becomes available. Please we encourage you to send questions towards the end of today's workshop. And let us know if you are trying to connect to different resources. We'll highlight them. We'll be sending out lots of great information. I'm going to pass the baton now over to Jeff Wood to intro himself, as well as to share a little bit about what we'll be learning today. Thanks so much, Jeff and Valerie, for being here. Jeff, go ahead and take it away.
Okay, thank you, Tashwana. My name is Jeff Wood. I'm a sales manager at HomeStreet Bank. I've been with HomeStreet Bank now for 22 years, working with Affinity lending, which is part of your benefits package. So I'll talk about that a little bit later today. But we're going to go through and talk about credit today and kind of some just basic information, what you need to know about your credit, and just kind of go what's on a credit report, what information's there, credit score factors, how to improve your credit score. So if you have lower scores, you want to get those improved, we got some tips. We also have some other tips and resource guides to help you reach out and talk to other nonprofits that we work with that can help you get your information back. And then also I'll talk quickly about what your benefits are with University of Washington and HomeStreet Bank and what the program components are. So we'll kind of get into that today. So first, we're going to talk about credit information. So the big thing about credit reports is they're kind of tied into almost every facet of life now. So our credit report, it's a consumer report. It contains information about where you work, where you live, how you pay your bills. It also may show whether you've been sued, arrested, filed for bankruptcy. It has a lot of information on there. So it's not just, oh, how I pay my bills. Here's my credit card debt. Here's my house loan, my car loan, my student loans. It's got a lot of other information in there that companies look at for hiring. They look at for different uses. And so companies called credit reporting agencies or CRAs, you'll see CRAs abbreviated a few times in this presentation. They compile, sell all the credit information to businesses that need your information. So that's how it becomes readily available for these different institutions to evaluate applications for your credit, your car, home, auto insurance, boat insurance, anything like that. Employment, a lot of employers are now looking at your credit report as a evaluating factor on getting employed or getting a job with them. Then also for other purposes allowed by Fair Credit and Reporting Act, the FCRA, there's certain reasons that they can pull your credit report. So they have to have a reason to pull the credit report, and typically they will have your permission as well. Excuse me. Some financial advisors that you periodically review your credit report for inaccuracies or omissions. It's really important to do this considering if you're making a major purchase, buying a home. Checking in advance can help you really improve the scores or figure out what you need to do in the process before you buy the house. So we'll talk a little bit what goes into a credit score. Now, most lenders use a FICO scoring system. So you'll see some agencies out there like Credit Karma and things like that. They don't use a true FICO system, so they don't get everything that's in a credit report. So sometimes I have customers that come to me and say, oh, I have great credit, 750. Well, Credit Karma might be telling them that, but that's more of a consumer credit where the scores might be a little bit higher, whereas the reports that most lenders will pull are a little bit more thorough. They're going to have everything on your credit report, and your scores could be a little bit lower depending on what's happened with your credit history and what's reporting. So what goes into that credit score? Again, credit scores go from 350 to 850. So that's kind of the range for FICOs that we use. 35% is based on your payment history. So everything that you pay, they keep track of it. Now, if you miss your due date, let's say your due date, what's today, January 19th. Let's say your due date was yesterday, January 18th. Most cases you missed the due date yesterday, you're just going to pay a late fee. So that late payment is not being reported to the credit bureaus. It's when you miss your payment February 18th. So if you don't make January's payment until after February 18th, then yes, you'll have a 30-day late on your credit report. That's your payment history. So it's 30 days for your credit card accounts, most of your car loans, things like that is your due date. So you want to make sure you don't go past 30 days after your due date, because that will start reporting on your credit report. Now with homes, typically a home loan you purchase, your payment is due on the 1st, late after the 15th. You always want to make that month's payment before the last day of the month. So this month you want to make it before the 31st. And February is one of the main ones that you have to just kind of worry if it's a 28 or 29-day month. But typically you want to get it paid before the 1st. Otherwise they count that as a 30-day late. So that's 35% of your score. That's quite a bit. The next part is 30% is based on the amount you owe on your accounts. So with credit card accounts, this is where you can improve your scores. So they look at your credit cards. If you're carrying a balance every month, anything over 25% of your credit limit is usually bringing your score down. So the higher the amount owed on your credit cards, the more brings down your credit score. So this, if you owe a lot on accounts, 30%, it could bring down your score quite a bit. So there's 65% of your score. Next is 15% is based on how long you've had credit. So when we first pull the credit report, kind of gives us a snapshot. And it shows you, okay, here is so-and-so's credit report. They were born on this year. This is when their first credit card was opened. And it tracks you from when you opened your first card, your first student loan, your first car, all the way to now. And that will have all that information on there of all the accounts that you've had. So the longer you've had it open, the longer you've had great payment history, and the lower balances that you have, the higher the scores will be. So again, there's about 80% of your score. Next is 10% is based on applications for new credit. So yes, sometimes if you pull your credit a number of different times to look for different things, you can lower your score. Now, the myth that a lot of lenders will do at car dealerships, at home, for banks for buying a new home, you have to be cognizant of it. You have a 45-day window to pull your credit report. So you're not going to be getting hit with a bunch of inquiries if you check with ABC Mortgage, HomeStreet Mortgage, Wells Fargo, any of those, the banks you check for a mortgage, you're not going to get hit with a new inquiry within that 45-day window. Now, if you go out and you look at cars one weekend, you go apply for a home this next weekend, and open up 2 more credit cards, yes, your scores will start to drop. Those are 3 different inquiries for 3 different loan types. So you want to be careful, hold on to that social security, date of birth, all your personal information as much as possible to not have it pulled if you're out shopping for cars, if you're out looking. Just kind of keep that information tight-lipped for in the beginning. The next part, the last 10%, is based on the type of credit used. So if you use harder money loans, let's say higher interest rate loans, to let's say get you out of debt, maybe the higher 25% interest rates, or they used to be called hard money lenders. You see a few out there anymore, like Lendmark and a few companies that will lend you money based on a certain term. A lot of times those will give you a little lower credit scores if you continually use hard money lenders, or if you're using credit cards that are mostly used for first-time home buyers and you've got those maxed out. So a lot of times they can negatively affect your credit if you're using higher interest rate credit cards or higher interest rate loans to get through something. So that's 100% of the score, kind of the breakdown of how they do it. So the other thing I always get asked for questions is, how do you get a credit score? Sometimes I get customers that they don't have established credit. So the other part is at least have one account open for 6 months. So getting that account open, that will at least get your score on there. And one undisputed account to the credit reports in the last 6 months and no indication of being deceased on the report. So I've had some customers where their spouse or their partner has died, and sometimes they get tagged with, okay, they've passed when it was their spouse or their partner. So that's one thing you do want to check when you're looking at your credit report to make sure everything is reporting correctly. Now, there are ways to open up accounts, and I'll talk about that a little bit down the road if you don't have a credit score. So there's ways of working to get a score started if you don't have established credit. Next part is improving your credit score. Excuse me. So how can consumers improve their FICO scores? The main thing is paying your bills on time. So try to keep past due accounts current and keep them current. If you get behind on credit cards and you need some help, call the companies, talk to them. Usually they have workout programs. They have ways of helping you get back on track. So it's like, if you have to sit and pick and choose for a bill one month, call them, talk to them, say, hey, I can't make it this month, or I can make it a little bit. I can't pay 250, I can pay 100. So work with them and keep those commitments. So if you commit to $100, pay that $100, they'll work with you. That can help your credit as well if you're making sure that they know that you're a little behind and you're trying to get caught up. Next part, I talked about a little bit, keep your account balances low, typically below 25% of the credit limit, especially on credit card debts. Where I see a lot of customers that are buying homes is they consolidate all their credit cards into one 0% interest rate or a low interest rate, and they max out one card and they pay everything off and close it. That really drops your credit score, because again, you reduce the time of credit cards that you have a brand new account that's fully maxed, you closed all the accounts you have history with, so that can lower your score. So try not to close accounts. Paying off debt rather than moving around, what I just kind of talked about. Don't move it to one big account. Try and get it paid down. Do a cascade effect. Try and pay the highest one off first or the lowest one off first. And once it's paid off, move that payment to the next one and next one, and just kind of let it roll down and pay off the next card. I have some customers that like to do it from the bottom up, get the small ones done first. I've seen some customers that do the highest way. I prefer going the lowest first, my opinion, just to pay it off a lot sooner, get rid of those small ones, the small pesky ones first. Again, don't close existing accounts. This may lower the score because that's your history. Limit applications for new revolving debt. Do not increase your available credit. This includes credit cards, department store cards, etc. So try not to access more credit if you're trying to improve those scores. The other part is, if you do find something on your credit report, you can dispute it. If it's inaccurate or missing information, you can get that updated. So if you do need information on that, we are a good resource for helping you dispute something on a credit report. We also have some other nonprofits that we work with that can help you dispute things on your credit report. It is a very long and arduous process. But they have 30 days usually to get that inaccurate information off. If they don't, they have to tell you why and why they're not taking it off. So keep that in mind. If you are disputing something, we have to have it resolved before we can even do a loan. So if you dispute a credit card or something that's on your account and it's found that it's yours, or they don't remove the dispute, we have to have it removed and rescore your credit, because we can't have any disputes on your credit report when doing a home loan. So I'll kind of talk into tips and resources next, just kind of some of the resources that we have at HomeStreet and with some of our nonprofits. But this is a great one. If you, I know we're going to record this, but this has the information for Equifax, TransUnion, Experian. Most of the times the 1-800 numbers work. I find that the online, going online and kind of registering on those is usually the best. Just keep your passwords. The biggest thing I have is when somebody goes and does a credit freeze on Equifax, Experian. I think Experian is probably the toughest one. Remember your passwords and your logins for each one of those. If you set up any fraud alerts or any credit freezes, because you have to get back in there, unfreeze them for us to pull your credit report again. So it's a great way to do it. If you have fraud that's committed against you and you wanted to freeze your credit reports, it's a great resource. So keep these in mind. If you want to take a quick picture of these, do that so you have the information. But again, this is a lot of times if you just write Equifax, TransUnion, and Experian down, their information is pretty readily available on the net. So other things we could do, consumer protection information, including how to file a credit dispute. You could always get a free fact credit report. You got to go to annualcreditreport.com. You can call the 1-800 number. I've never done that. I always go to annualcreditreport.com. It's a great resource. You can pull your credit once a year for free. So if today's the day you do it, January 19th, always go on January 19th, pull a new credit report, take a look at it. It'll give you the report, give you everything on your credit. It just will not give you scores. I think they charge you for your credit scores. So this is a great resource to do it. I always recommend checking it once a year. Don't go to freecreditreport.com or any of those. Those are paying services. They charge you for doing services. The only one that is free is annualcreditreport.com. FICO consumer websites, you got myfico.com, scoreinfo.org. That kind of gives you some more information about FICO scoring. And then one of the nonprofits that we use here at HomeStreet is based out of Bremerton. They're here locally. They do most of their stuff, or they do most of their counseling over the phone or via Zoom or online classes, but they do credit counseling. They do the credit counseling they do charge for. That's if they're paying your bills for you. They negotiate your debt down to 0% interest rates and pay your debt for you. That is one thing they do charge for, but most of the other stuff they do for their budgeting, their credit repair, a lot of different things, bankruptcy for prevention, foreclosure prevention. There's a lot of things they can do. Or if you do own a home, and let's say your mortgage company is a huge company, you can't get through, you're not able to talk to someone, they actually can be your intermediate and talk to your mortgage company for you. They're a great solution for this area to help you go get into a home or keep a home. So, and they also do a lot of our counseling as well for our first-time home buyers when we use down payment assistance. We also have the do not call list information here. So if you want to get on the do not call list, it's just the www.donotcall.gov. Register on there, register your home phone, your cell phone, and get on there for that information. Other resources, Consumer Financial Protection Bureau and the Federal Trade Commission. Looks like we misspelled trade. So, but everything else, those are some websites to visit in those instances. Okay, and the last thing we'll talk about is the Affinity Benefits Program and kind of the components of the program. So I'll talk about a little bit. Again, I've been with HomeStreet for 22 years now, part of Affinity for 19, almost 20 years. And what's nice about it is the cost savings that gives towards employees. So you get a discount from us of a half a point towards your loan amount towards your closing costs. So a $400,000 loan, you're going to get a $2,000 credit from us for your loan. We also have realtors that contribute. If you use one of our realtors, which you don't have to, they contribute up to 1% of their commission of the sales price. So a $500,000 loan, that's a $5,000 up to $5,000 rebate towards your closing costs. Now we have a wide variety of down payment assistance programs. We work with all throughout Washington, countywide. Some are state and local areas that we can do certain down payment assistance programs. Most of them are within Washington State. Financial tools and resources. We do free financial seminars such as this. We work with budgeting practices, steps to home ownership, a whole bunch of different things that we do work with on these webinars. We also have other newsletters that we send out, podcasts and recorded podcasts and more. And then also benefits are available to immediate family members. So your parents, your children, anybody that's immediate family can benefit from the same program. So you get the same discounts, they'll get the same discounts as you. They just have to let us know that you are the son, the daughter, the mom, dad of the UW employee. So we just have to have that email confirmation. And again, this program is exclusively to UW employees, but you have to contact one of us. So there's a group of us that work, and I think in the next part, it should show my information, and I can get you in touch with other loan officers within our group. But my information's here. If you have questions for me, my cell phone's there, my email's there. But you can also check out all of the benefits at homestreet.com/UW, and that has the other loan officers. We have Jessica, Nancy, and Ryan. We all offer the same program discounts. We all are knowledgeable with down payment assistance, different programs and pre-approvals for you. So, and I'll open it up at this time for any questions.
Thank you so much, Jeff. I have a couple of questions in the chat and then a couple that have been sent to me privately. So theoretically, does it ever happen that a person achieves a perfect credit score? A car dealer once told me that an individual would have to have absolutely zero balances due. What are your thoughts on this?
I think I think I've seen an 845 credit score. So essentially, I don't think anybody will have a perfect credit score. Most of the times it's somebody, I mean, if they have their house paid off and their car's paid off, and maybe they have a credit card that they pay off every month, and they're usually in their late 50s, early 60s, that might be the case. But again, if you're above 760 in most cases, you're going to get the best benefits for mortgage on the mortgage side. So having a perfect credit score isn't always obtainable, but you can be in the eights. I've been 807, 809, and it's not, I mean, I've never really thought of striving to have perfect, but because what they do is they give you 850 and they ding you down based on all of the things that you have on your credit score. So it's more of they bring you down based off the starting point of 850. So essentially not having anything on zero balances, you would start to lower your credit score because you have too much credit out there available and you're not using it. So it's a double-edged sword with credit. You have to use it or lose it, but if you use it too much, you get worse credit. So you have to be careful. It's a fine line between usage and not usage. So.
Wonderful. And can you share a little bit more or talk a little bit more about the various types of credit, revolving, installment, et cetera, and how they impact a credit score?
Correct. So the one thing that I always recommend when I'm talking with customers, because I used to use this example when I did home buyer classes. We used to be able to show side-by-side credit reports when we taught this class, but we can't do that anymore. But I showed an account where they paid their credit, they paid everything on time. They had credit for 15 years. They never had a late payment, but their scores were in the 620, 630, 640 range, which is kind of low to, we can't lend usually below 620. So their credit scores were really low. The thing is and this was actually a past customer too. They had 7 credit cards and every one of them was maxed. So their scores were diminished. Even though they made the minimum payment every month, they weren't paying anywhere on their credit cards. They're basically one accident, one car trouble away from kind of going under. So their credit reflected that. So I talked to them and they said, oh yeah, we pay cash for all of our cars, but they bought everything else on credit. So they had to kind of realign how they thought about paying bills. They hated having car payments, but they didn't mind about having credit cards, which was kind of the opposite. You want to have more installment debt over credit card debt. So if you have car loans, that's a set time. You're going to be paying that off in 4 years or 5 years or 6 years when you have that set term. With a credit card, you could have a $5,000 balance, make a minimum payment on that. It'll take you almost 21 years to pay that off, depending on the interest rate. I think it's like 15% interest rate. And so if you have a $5,000 balance and pay a minimum payment on it every month, it'll take you about 22.9 years to pay that off because it's compounding interest. If you're carrying a balance, they're charging you from the month before. So you're getting interest compounding for 45 days on that balance over and over again. So that's where credit cards can be kind of scary because you're always paying interest on months that you borrowed a long time ago. So you're always carrying that balance. So if you're paying it off every month, that's helpful. So if you have a credit card, it's great to pay that off. Okay, maybe you had a busy Christmas, maybe it runs a couple months, but if you're carrying a $5,000, $10,000, $15,000 balance on a credit card and you have a zero balance on a credit card, or you can do an installment debt, the installment debt might be a better option. Plus, the rates are better a lot of times. If it's a secured loan on a car, the rates might not be that great right now because rates going up, but it's got to be better in credit cards. Most credit cards are about 19% right now. Car loans, I've seen 6.5 to 8.5% right now. So you have to do your research on it because, again, installment debt, you're setting yourself up to pay that debt off. Let's say it's $15,000. You'll have that paid off in 4 years, where the credit card, 15,000, it might take you 20 years if you're making minimum payments on it and still using it. Because the installment debt, you just take it out the one time, you don't have to keep using it. So with my going back to that credit report, I talked to them. What they did is they moved all their credit over and did a car loan, paid it all off, improved their scores into the 700s. It only took about a month to improve those scores because they paid off their credit cards and got those down to a very low manageable amount.
Wow, thank you so much for spelling it out like that. I know for myself, I've heard of compounding interest, but I've heard it mostly tied to investments and how that works.
Mm-hmm.
I haven't made the connection just yet to how compounding interest kind of plays in the role of credit card debt and kind of making payments bigger over time. So that was really eye-opening for me. Thank you. A couple more questions. Can you talk, what is the minimum FICO score one needs to get in order to get a home loan?
So it depends on the program. We have some programs like FHA and VA that'll allow you to go as low as 580. It doesn't always approve you if you have scores at 580. Typically, they like to see 620, 640 or higher. I have a customer that was trying to do a VA loan for 580. It wasn't liking it, wasn't approving it. So you have to be careful. Just because it says you can go as low as 580, they'll take it. They don't always take it. So it really depends. If you have low credit, but you have, let's say, a great income and a lot of assets, they might approve it. So there's a lot of things that go into it, just not credit score. So the credit score is a main factor and can guide me to what direction you want to go for a loan. The ideal loan you want is a conventional loan or a Fannie Mae, Freddie Mac loan, which would be probably a 680 or higher credit score. They will go as low as 620, but again, they don't always approve 620 credit scores. FHA will go 580. They like 600 to 640 more. USDA, which is a zero down rural loan, they'll go as low as 640. And then VA, like I said, is 580. But again, I see more 600 to 620 for credit scores there. Most down payment assistance programs need a 620 or higher. Some need 660 or higher. So depending on the down payment assistance side of it, if you're using those programs, they do require a little bit higher scores. Let's see, 680 for Fannie Mae. A lot of correspondent banks that we work with want to see 720 or higher. Right now, they're tightening the guidelines a lot just because of the higher interest rates, higher debt to income ratios. They want to make sure everybody, if anyone's buying a house, that they have the reserve. So having a large savings after you buy the house or a retirement account that you can fall back on in an emergency is a good thing to have. But they want to see reserves. So reserves is the money you have after you close your house. So if you have 5%, 10%, 20% down, they're also going to see, what do you have after you put 20% down? Do you have any money left? So if you use all of your assets to get into the house, it might not be as good of an approval if you have some money sitting in savings after you close. So they like to see 2 to 6 months of your payment, your new house payment. So if your house payment's $2,000, they'll want to see $4,000 to $12,000 in your savings or retirement if you have that in your retirement account.
That's really helpful. Thank you, Jeff. Another question. So sometimes the 3 credit bureaus have different FICO scores for a person. What explains this and how does one solve it?
So the FICO scores, it's interesting because some companies don't report to all the bureaus. So one thing you'll notice, and there's a lot of reform going on with collections and things because they're not supposed to be putting collections on credit reports anymore, especially medical collections. So that's still changing. I haven't seen kind of the ramifications of that yet, but not every company reports to all three bureaus. So you might have, and where I've seen it the most is collection companies, they're going to report to TransUnion and Experian, but they won't report to the other because it's cheaper just to report to two. It'll affect your credit if they report to two, and they know this because we always take the middle score. So if they're reporting to two, that's going to lower two of your scores. So we have to take the higher of those two low scores. So that's kind of their way of being inexpensive or cheap to get by with reporting. But most lenders report all three bureaus. So when we report your mortgage payment, we're reporting to all three bureaus that you're paying on time. So if you look and see on the different credit reports on your score, it'll say who's reporting in what bureau. It'll be Equifax, Experian, or TransUnion. They're abbreviations, and it'll tell, okay, who's reporting this and the account that they're reporting it on each trade line. So it's nice to look at that and see who's reporting it. Why is this score 615 and the other 715? So you're at 715, 718. Maybe there's a parking ticket that blew off your car and they're reporting it based on that, which they're not supposed to be doing parking tickets anymore either. But I haven't seen many of those. Used to have those a lot with the city of Seattle. But again, those reported to two different bureaus as well. So but most of the time collections will go, or one of the main offenders with reporting to two bureaus and not one. But most other lenders should be reporting to all three. If they're not, again, it's probably a cost savings measure, so they don't have to report to all three. So hopefully that answers the question.
Wow, that's really insightful, especially about the parking tickets and kind of the other things that have shown up on credit reports over time that thankfully are not anymore. And yes, that did answer their question. So thank you. It's kind of related. So how often does a credit score get updated, and how long does it take to improve my score?
So it depends on if it's faulty information or not. So if it's something where you've disputed and they've removed it, they have that 30 days to remove it. So your score should improve within that 30 days once they remove that item. And so that's one reason we don't want disputes on the credit report, because what the bureau does is if you're disputing something, they will remove it and say this is in dispute and it's not being calculated in your score. So you're like, ooh, I got great credit scores. But if it's being disputed and not removed, it's negatively affecting your credit because it's raising your score without that info. So that's why banks will want that removed before we make a decision. So if you have a dispute, you want to make sure it's resolved and cleared up before a lender pulls your credit report, because we're going to have to say, okay, get that removed, and then we'll repull it and have it updated. So that's the one thing you want to look at if there's something on there incorrect. Now, if it's a type of healing, let's say you have an account, let's say you have a collection account and you paid something off, there's no real quick fix for that. Actually paying off a collection account can sometimes lower your credit score because you're updating that balance and saying, yes, I did incur this, I paid it off. So now your report date is now. And so it's actually updating the date on it. So it could lower your scores a little bit if you pay a collection off. Don't pay any collections off or anything on your credit report until you've spoken with a lender, because you might not have to pay it off. It might just be something that can be forgiven, or we don't have to look at it, especially if it's under $1,000. We don't look at it in most cases. Now, if it's something where you've paid down your credit cards, let's say you had a $10,000 balance, you paid it down to $2,500, it can take a couple months for that to heal because it needs to take some time to lower and say, okay, the score, it's under 2,500, they're managing that debt. It may take a couple months. We have a tool in our box that we can use. It's called a rapid rescore. It's something that the bank can pay for and on your behalf and do the rapid rescore. Now, we don't do it for everyone, but if it's something where you're not going to qualify for the loan because let's say your score is 650 and we need a 700 credit score, let's say something improves your credit score 50 points by removing it, we can say, okay, we're getting it removed. We do a rapid rescore. The credit bureau acts as if that's been paid and it's cleared off your account. Then they update your credit score. So we pay a fee for this. It's usually about $75 per line per item. And so sometimes it's about $225 per item that we have to pay to have it done. So as a lender, we want to make sure it's something that makes sense to do, because we can't just go and pay, do this for every loan, because if it's not a loan closing, then we just spent $200 to $500 to correct somebody's credit that's not doing a loan with us. So we have to limit on what we can authorize to do. But if it's something that can improve your situation and get you into a house, we do have that tool. But usually it's time, 2 to 6 months. If you paid something down, your scores should start improving. I've seen them improve within a month. Customer paid off a credit card, got it down to $1,000, and it improved his credit quite a bit. He was able to apply for his loan just a month later. So.
Wonderful. Thanks so much for that. Can you talk about the impact of filing bankruptcy on credit?
Okay, that's one thing we didn't talk too much about on this slide. So, the hierarchy of payments and what will affect your credit the most. The hierarchy first starts with any mortgage loan. So mortgage loan, a late payment on that is probably the worst thing to your credit. It can actually drop your score 30 to 50 points. A late on a car loan is next. If you have a car or student loan with the late payments, those start to negatively affect the credit reports. A credit card or department store card, a 30-day late on that, it's not as detrimental. It might drop you down 10, 15 points. So that will take some time to heal on any of those. Mortgages, usually it's a 12-month healing process to do anything with a mortgage after a 30-day late with a mortgage. So it's key to make payments on time, especially for your higher accounts. If it's a credit card, like I said, work with them, work with the credit companies, talk to them, make those payments last. Make your house payment first, car payment. It's your housing, your transportation, and next is food. So you just have to keep that hierarchy and make sure that you're paying those things first and then do your credit cards. So keep that in mind. Now, with the effects of different things on your credit report, foreclosures is one of the worst things on your credit report, because that'll be on there for at least 7 to 10 years. So walking away from a house or a short sale, the short sales haven't been as bad on credit, because you do sell it and have a loss, and you have to pay basically the difference on the loss that the bank took. You have to pay taxes on that. We aren't seeing too many anymore with the amount of equity that we've had. But with a foreclosure, that affects your credit. That can drop you down probably 200 points, a foreclosure on a house. Bankruptcy, it's probably 100, 150 point drop. And now the thing with a foreclosure, with a home loan, FHA won't allow you to buy a house for 4 years. Conventional, it's 7 years for buying a new house. There's some exceptions if you have the foreclosure. With a bankruptcy, Fannie Mae usually wants you out of bankruptcy. I want to say, is it 2 years? I'd have to go back and look. They've been kind of changing a little bit, but bankruptcy, I believe, is 2 years. 2 years for FHA and VA, and I want to say 4 years for Fannie Mae. So they can affect the type of program you have if you have a bankruptcy in your past. So it'll take you a little bit more time to buy a house. You'll have higher rates on car loans and everything else. But the main thing is what we look at is what you've established your credit after a bankruptcy. So the big thing is, if you do have a bankruptcy, let's say it's medical, let's say it's something where you had to file against a bunch of bills, it's how you establish credit after you file. So it's not something that's like, oh, I can't do anything for the next 7 years. I filed bankruptcy. Try and get I'm blanking, a small credit card. Credit unions, we actually offer one too, where you can do a balance and savings, and they do it's a secured credit card. Thank you. I couldn't remember the name real quick. The secured credit card, where you put $300 into a checking or savings account, and you draw the money, and it pulls that money out of your savings, and you're basically paying yourself back in your savings account when you make payments. That will build your credit back up. So just establish your credit after a bankruptcy as much as you can. It may take a little while. but just start making little payments on things, kind of get that credit established after a bankruptcy. Lenders do look at that quite a bit.
Thanks so much. Another question. I've learned about adding my partner or child as an authorized user to my credit card to build their score. Can you talk about what that process is and if there are any downsides to it?
There's some downsides. I've seen where one of my loans I'm doing right now, where my customer and his partner, they had dual accounts because he didn't have credit, but they're buying a house together. Well, they split up. The other one stopped paying his bills. Well, it's affecting his credit because he's an authorized user. He's getting it removed, which is nice because his scores will bounce right back up. But it helps build credit, but it also can dismantle somebody's credit. So just be careful with that, especially with children. Or if you have a junior senior situation, let's say you named your child after you, which is not usually recommended in my opinion, just because of credit. I've seen it just demolished. I've seen 18-year-olds take a dad's credit and just run it to zero. And they just kept opening new accounts fraudulently. So you want to be careful with that because they commingle same names real easily. I don't know if it's as much, I don't see it as much as I used to when I first started 25 years ago, but you used to see a lot more where same names just got mixed up quite a bit. But you just want to be careful, and they know what they're getting into with an authorized user. It does help build a spouse's credit. So if you have a partner or spouse that needs credit built, I'm working with a customer right now. Her husband's from Mexico, and he doesn't have a lot of credit. He did a secured credit card, and she added him to two of his. His credit's built up. He bought his own vehicle. So it does help. It does help get their credits done. With children, I've seen it where they send them off with an authorized user with a credit card to college. Typically, they won't let you do that, I believe, until you're 18. So it just depends on what the age of that child is. But that's a great way to get them established. Typically, student loans is where I see a lot of college students that have established their credit because they've got student loans and they haven't made payments, but they've got great credit, which is kind of interesting because they're not making payments on it. So since they're deferred, but it's great ways to establish credit. I think if you're just getting started out, the secured credit card's a great way to go because you can do, it's $300 of your gas. Let's say you use it for gas money. You go in, you buy gas, you pay it off each month. So that will establish your credit. The other thing you can do is self-report your utility bills. Sometimes you can do your rent or utility bills and self-report that to the credit agencies. So there's ways of doing that as well, where they will keep track of you making your payments to your credit company or your power company or your gas companies.
Wonderful. Can one apply for a credit card without a social security number?
No, they typically need either the social security number, I believe, or the what is it, the TIN, I forget the identification number. So typically they do need one of those. So if they don't have a social, and that's not really my expertise with credit cards. For us, we have to have a social for home loans. So with the banks, I don't know their criteria for credit cards or for even opening a checking and savings, what they would need. They could email if you want to email me later, I can always ask my bank branch what they require.
Wonderful. Thank you so much, Jeff. Those are all the questions that have come in so far. I'm going to leave it a few moments to see if anyone else drops a question in. Otherwise, we can wrap.
Okay. Hopefully everybody got their questions answered. But again, if you do need to answer a question, feel free to email me or send me a quick text. That is my cell phone number. I'm heading off to a couple of appointments after this, but send me emails. I will answer those. So probably not until tomorrow morning I get bombarded.
I bet. Awesome. That is all for today then. We will go ahead and wrap up, and we will also be sharing the recording as well as resharing contact information as needed. Thank you so much, Jeff, and thank you all for bringing your questions and minds to the table so that we can learn together. It's much appreciated, and thank you. Have a good rest of your day, you all. Take
Thank
good
you.
care.